Hey, greetings and happy Thursday. It's my guest captain interview day on Thursdays. I call it my macro to micro power hour with a guest captain. Today it is Barton Wang, and I'm going to look for him here very shortly to promote to panelists, but I wanted to invite you and thank you. Hey, there you are, Barton. Great. Greetings.
Hi, Samantha. How are you doing?
I'm doing great. Let me just turn this up a little bit and give a little bit of an intro with some housekeeping before we dig into it. But I'm so glad to finally do this. Um, for those who are joining or maybe new, I'm Samantha LaDuc, founder of LaDucTrading.com, and I am very excited about learning about subjects, if you will, that I don't have a deep expertise in. And this is something that Barton has just mastered, and he has recently launched a newsletter as well to basically express how he trades this Fed liquidity and market movements. So there's lots to dig into, but first, a little housekeeping. We have, oops, let me just do a little share screen so you know where we are and where this is going after it's done. So Macro to Micro Power Hour is every Tuesday and Thursday, and I will oops, hold on, let's do this. Is every Tuesday and Thursday, and I will upload it to my YouTube channel, which is LaDuc Trading, YouTube channel, and it comes right down here. So on Tuesdays, I have a running commentary, if you will, on a thematic market topic. This Tuesday it was commodity super cycle, if that's going to continue, etc. We talk rates, we talk dollar, bonds, big macro themes, and then drill down to market moving, basically market structure. But yeah, I've got this, will be posted right after. I will post it here for those who want to attend and download it later. But also, this is very much, all right, my pleasure of having Barton Wang in for an interview so we can learn more about liquidity. And welcome. I'm excited because we've not done this. I've just watched your Real Vision videos and pinged you for a few questions. And now I get you live and ask clients to also kind of send me questions to get to you as well. So welcome, Barton.
Awesome. Thank you for having me on, Samantha. We've been following each other on Twitter for how many years?
Uh,
Since 2018, right?
it's been a little while, and then we got really worried about COVID, early last year, and you were way in front of it and provided a public service, I swear, with all of your detailed research, not only from your doctor frame of mind, but also from the market frame of mind, and it was spot on. And you know that I was very in tune and worried about it. I remember I wrote on January 31st, perfect storm, coronavirus and market risks, and there were 2,300 cases recorded at the time. So
Right.
I was obsessed with it for about 30 days, and you and I were talking a lot via DM. So thank you also for that support because it felt very, very scary at the time.
It was quite for me, for personally, it was an accidental crisis because some of my family members lived very close to Wuhan. I'm glad that's mostly behind us right now with the vaccine being rolled out pretty quickly.
Yeah, it's manageable. So are you, and I know you got the vaccine, you tweeted about that. And did you also get COVID?
I thought I got COVID, but my blood test always came back as antibody negative. I always got some fever and a couple of sort of ambiguous symptoms that can be COVID, cannot be, maybe not, during the 2 peaks of for Texas. So at the time, it was really hard to get a COVID test unless you have a really high fever.
Yeah.
But my antibody always came back negative after those 2 episodes. So I assume it was not COVID, or
But
it was.
you were so in tune with the science and the protocols and the at the time, obviously, policies, governmental policies. So you tweeted a lot and had a large following on that and how it impacted market. And then you really had already been doing a lot of work in Fed liquidity and such, which was something that you were tracking and also posting in regards to market movements, how it would time very, very well. They were tight fractals, if you will.
That's
And then,
right. That's right.
so now you've really made that a focal point of your trading activity.
So my trading mostly are in the realm of equity options. I occasionally dabble into uh, currencies and commodities, but mostly it's in equity
Yep.
options. And for me, there are mostly two things that are driving the market, the equity market. One is the option positioning, and the other one is the Fed liquidity. In other words, the bank reserves. And um, I would think that I would consider the options positioning and the option flow is more of a day-to-day kind of influence to the market, while the Fed liquidity in the regular time should be sort of a invisible hand that gradually move the market, sort of guiding the 20-day or 50-day moving average, if you will, making sure that slope is going up or going down, that kind of situation. But occasionally, for example, in 2018 and for the second half of February and probably March, the Fed liquidity can have some acute influence on the market movement. And we could see some really bizarre sell-offs and bounces that made a lot of people pretty frustrated because the market was just top back and forth for no reason, seemingly for no reason. But there are very good reasons if you look at how the Fed, Treasury, and the GSEs, which is basically Fannie and Freddie Mac, are moving their money around in the past 60 days. That could cause a lot of market dislocations because of how banks are managing their cash and how they have to do certain maneuvers on their balance sheet because of the new regulation that was put into place after 2018.
So how did you get so interested though in this, the funding markets and the plumbing?
Right. Well, this is, I started to track this very carefully on a day-to-day basis. Back in 2018, if you remember that after the XIV
Implosion.
implosion in February 2018,
Yep.
we entered into a period of QT mania where the market will go up in the first half of the month and then go down in the second half of the month when the Fed is doing quantitative tightening. It went down for a little bit in the first half of the year and then kind of disappeared into the summer because the option market was giving a lot of support. The gamma was extremely high. For, the dealers were holding positive gammas. But in Q4, the market is kind of crashed after October.
But that was 2018. And just to back up a little bit, do you think that, did you at the time think that obviously short sellers were scared and some were taken out in, I'm talking VIX short sellers,
Right.
were taken out in body bags. So there wasn't this, impetus to keep that activity going. How much weighting did you give to the structure of the market just changed dramatically since, and it hasn't really recovered since?
It kind of recovered, I think, in 2019. In 2018, there was an acute crisis of a bank reserve shortage. And as a result, there are days when there's a acute shortage of bank reserves. There's just literally no buyers in the market. So any catalyst that pushes the market down will go way down. And that happens almost always in the second half of the month. So that's why you get all these sell-offs in 2018, the second half of the month.
When you say second half of the month, you mean post monthly options expiration and VIX expiration?
For the most part, after the post the option expiration, sometimes even before that, you'll see the peak on the 15th or 14th because on the 15th, Freddie Mac started to do their QT.
Okay, so it's not about front running the fact that the options and that gamma is rolling off, or that now VIX will be set free because it's really, it's almost contained through options expiration. So you don't give it as much weight to those factors as you do to the Fannie Freddie 15th event?
Yeah, for 2018, there are I think there are 5 months where Fannie and Freddie played a huge role. There was just a crazy high sort of correlation between how and not only the data, but also the amount of the liquidity they're taking off from the market. I'm talking about system liquidity, bank reserve, not the liquidity in the future or option market. And it's just the coincidence was too great. Always happens on the 25th when Fannie Mae did their thing, and always on 22nd or 20th that will be Ginnie Mae doing their thing, and then on the 15th is Freddie Mac. So when it correlates really well and for quite a long time. And it's just
What did you say the correlation was? Say that again.
When they correlate, they
Yep.
correlate for months, for like 2 months, 2 or 3 months. And then once after the QT weeks, QT days were over, in the first half of the month, everything will recover because this is a temporary dislocation. Certain banks got squeezed because the balance sheet management was not prepared for this. But over time, over 3 or 7 days, they will be able to maneuver. They were able to get a bank reserve from other banks, and then things will recover. So it's never a permanent sort of sell-off of the market. It's always temporary, lasting for a couple of weeks, and it will bounce back. And it's very useful if you are doing swing trading, because if you can predict those moves and anticipate those.
What are the dates again? No, specifically. I know you write about this, but tell me the dates again, because you referred to the 15th very often. But
yeah, it used to be 15th, 20th, and 25th. That's in 2018. Right now is mostly on 25th because quite a few things has changed in 2019 and how Freddie Mac does their mortgage-backed security prepayment.
so what happens on the 25th, and what's the market impact?
So back in, 25th has a pretty big impact right now in 2021, as well as in 2018, okay? What happened on that day is the prepayment date used to be just for Fannie Mae, and now it's for both Fannie Mae and half of the Freddie Mac mortgage-backed securities. Freddie Mac has changed a little bit and moving to this date as well. And it's a huge amount of money. We're talking about in February, it was $192 billion on a single day. Last month, March, was a little less than that. It's about 140 billion, but it's a lot of money. So what they do is before that date, they take the money out of the commercial banks where people pay their monthly mortgage payments, the mortgage servicers, or there's refinance activity, and then you have money that pay off your previous loan, right? Mm-hmm. So these are collected by Freddie and Fannie ahead of time, and that takes money out of bank's reserve and put money into the Freddie and Fannie have special Federal Reserve accounts. They didn't use it in 2018, they're using it now in 2021. They'll take those money into their Federal Reserve account a few days ahead of time, and then they will release all that money to the banks, to the mortgage-backed security holders. So it's a different group of people. And back in 2018, Fed takes a chunk of this money because that's basically some mortgage, used to be some mortgage-backed security held by the Federal Reserve Bank of New York as part of the QE program. And then once some of these money was paid back, they just take it off, right? So that's like the QT. It's the quantitative tightening, the balance sheet shrink a little, $20 billion or something, as this money was paid to the Federal Reserve. So back in 2018, it was from commercial banks just directly to Federal Reserve and get destroyed on that day, during that morning. Right now in 2021 is slightly different. It's that the Freddie and Fannie, they took money out of commercial banks a few days ahead of time, and then they sit in the Federal Reserve. You'll see in Federal Reserve H.4.1 report, the other balance, that's where the money is stored, shoot up by $100 billion, and it's released in the morning of 25th to the banks. So all the banks all of a sudden are sitting on 140 billion more reserve, and that's creating a crowding out effect because banks' balance sheets are really full right now. There's something called SLR rules.
But hold on, before we go to the SLR and the crowding out, because I definitely want to dig into that. Go back a little bit to this, 100 billion deposit, for lack of a better word. Is it consistent? Or, for example, mortgage refinancing, plummets one month to another because interest rates just shot up, housing supply, whatever, constriction. Does it impact this flow of future monies in the plumbing for the next month? In other words, do you watch that metric at all? That housing, that refinancing mortgage metric, and how does it impact? What's the time lag?
There are a couple of things at work here. Number one is exactly as you point out, the refinance activity matters a lot, right? And this refinance activity actually made this amount went up by 3x in comparison to early 2020. So this year is way up. It used to be just
sense. Okay.
$80 billion. Now it's like 180 adding together.
It.
Number two, it used to be just Freddie doing it only on 15th and Fannie does it on 25th. And now Freddie is moving to 25th as well. And that's making it even bigger on 25th. Number three, the money market, I know you have followed a lot of people in that, and you sometimes tweet about the repo rates going negative on some of the days, right? So Freddie and Freddie, they still have the ability to deploy this cash in the repo market. They're big players there too, to get some, overnight, just put money there for a few days to earn the overnight interest rate, right? But because the repo market now in many days, they have negative interest rate, very small, it's not super negative, just slightly negative. It's better for them just to leave the money at the Federal Reserve, because then you don't even, the interest rate is zero, but still it's better than negative. You don't lose any money. So this is something pretty new this year. It used to be that Freddie is doing very carefully with their cash management. Freddie never keeps a lot of money, or no money at all at the Federal Reserve. Only Fannie will do that. But this year, because of the negative interest rate in the repo market, both of them are parking a lot of money with the Federal Reserve directly, and that's exacerbating the huge up and downs in the Bank Reserve in the second half of the month.
And take a leap with me right now just to understand, is there any resulting activity in hedge funds, for example, the overnight lending rate, which obviously can help their leverage in trading? Do you follow any of that activity?
Yeah, I think this affects the leverage or the buying power.
Because 92% of S&P gains occur not in the cash session, but overnight.
Absolutely. And
plumbing is supporting that. I'm a neophyte. Explain to me how that is possible.
I think that's more of so the overnight ramp, right? The overnight ramp happens a lot on these on the days when NQ and ES really take off, and it usually, like today and yesterday, it was an overnight ramp, and then we kind of just go back and forth, stagnate at the level we had during the cash hours. I think it's mostly future traders or banks or hedge funds trying to use the low liquidity for the overnight sessions. Some part of it comes from Asia and from Europe, right? They know that the option market maker will have to hedge because of their gamma positions, so they ramp up the future overnight, and then they can sell it back to the option market maker at 7 a.m. Eastern time when they start to hedge their delta, and then these people just disappear during the cash hour because there's so much liquidity, so much trading going on, and they're not going to move the market very much. So
we know. So you've explained that extremely well. We know why it's happening, not necessarily who. Invisible hand. how is it related to the funding markets that you track? Whether it be negative repo and the parking, whether it be the plumbing of Fannie Freddie, like how is this intersecting to support a 90%, 90+% ramp in the futures market versus cash session consistently over the past few years?
Right. That's a very good question. So where does the money come from, right? So if we look at the bank's balance sheet, that's something that's not many people, it's not common knowledge right now. It's like, look at after this entire COVID crisis, banks have been holding a lot more cash because of stimulus and all that. The bank reserve has gone up, deposit has gone up. So on the asset side, they had a lot of more cash. They have a lot more treasury bond. The actual commercial lending to the commercial and the industrial loans has fallen for the past 12 months, right? The corporate bond market has grown a little, so that's the S&P 500, the big corporation, the IG and HY. Those big corporations have been able to tap into this and get more money. But I think the Main Street hasn't got any money, or probably even got less money at all.
Well, they have the PPP and the SBA loans from this crisis handed out, but very different.
Very different. It didn't grow by 2x at all.
Correct.
If you look at it, M2 did not grow 2x. What's not being tracked on the Fed M2, M3 metric, which is happening through the repo market, as well as the other thing you can track is, for example, the margin loans on the broker dealers book. These are basically anything that's loan, right? The margin loan is a loan. It's credit creation. It's money creation.
Wait a minute. So how is that tracked? Like how big is that relative to? I mean, we just saw Archegos, 7x leverage and all of this leverage in the system. Margin loans, I think, would provide some pretty good data points.
There's no. I haven't found any good aggregated measure for this. This is all the part of the shadow banking market that through the securitization and repo market to increase leverage. This is really well. There's no incentive for people to be very transparent in this. And then Federal Reserve, they are nominally just looking at the commercial banking market. They're not like really super active in regulating the investment bank part of the financial market. So it's the good data there is very hard to get by, and it's very late when you have them.
Okay.
But this is a very good point you're making here. So that part of money creation through the repo and through the dealer broker arm of the bank holding company, they are sort of under the same constraint of the SLR rule because they're part of the bank holding company. So when the commercial bank's balance sheet is growing, that's going to squeeze the investment bank part of activity. So both repo and derivatives, the notional amount of those will have to shrink when the commercial bank balance sheets are growing tremendously, like through what Fannie and Freddie has been doing, or through.
Okay, so this is a segue to the SLR and the requirements, I mean, the limitations basically, or the fact that they're almost at 20%. So is that correct? Am I or is that different?
This is exactly that. Yes,
Okay,
this is limited by SLR, and this is a huge difference between 2018 and this year. So in 2018, the reason why liquidity matters is a different mechanism called LCR, liquidity coverage ratio. At that point, it was bank reserve is really scarce. We don't have enough bank reserves, and that's causing the sell-off whenever the bank reserve dips below a certain critical level. Right now, we're on the opposite side. There's too much bank reserve, way too much bank reserve.
So I have to ask right away, is it a situation where it could actually fall under the weight of the supply, meaning the markets?
From the equity market perspective, it's not necessary. It's not a direct pressure on the supply. It's more of a removal of the buying power because of the because the broker dealers are unable to extend more.
Isn't that the same difference?
Uh,
Buying power is important in this whole margin.
yeah, well,
We
so
have.
it's kind of a ammo that requires a spark to ignite. You need a catalyst. If we don't have a catalyst, this condition could persist for a couple of days and nothing would happen. It by itself does not necessarily would cause a sell-off, but it just lay down all the very good, very ripe condition for a pretty large market move. But if there's no catalyst, nothing would happen.
So Archegos and the rest, not one particular hedge fund blow up is going to have an impact, but the very strong likelihood that there isn't just one cockroach, there are many with similar leverage playing the same game.
Right.
But what are and literally, I mean, any book that's leveraged 5-1, let alone 7-1, they have a 15-20% drawdown in their positions, and that wipes them out. So
there will be a lot of those, and
there will be a lot of those
every month after 25th, or near or around or after 25th, you're gonna see some fireworks. Back in January, we had GME, which also has to do with some hedge fund, right, Mervin,
yep.
Getting squeezed, and they kind of almost blew up, right?
Mm-hmm.
In February, late February, we have a lot of squeezing and deleveraging in ARK names. ARK have the names that heavily invested by ARK, right? There was a lot of deleveraging in that realm. These never happens in the first half of the month, always in the second half of the month, and always very close to 25th, right?
Interesting. Okay.
And then there are a couple of very interesting dynamics here, actually. For example, for Arch Ego, this is kind of a zero-sum game. If somebody deleverage, that actually leaves some room for some other players to leverage up, because the total amount of available balance sheet space for the broker dealers to turn that into total return swaps or other derivatives that allows a hedge fund to go on leverage is almost a constant, and it'll get squeezed a little around 25th. So let me just make another point here. When I say there's sell-off, the pressure to the market, because this is kind of a temporary dislocation, banks can always adjust their balance sheet. If you give them a week of time, they can move money around, right? So everything we saw so far it's like a round trip in the stock market. It's always getting pushed down, and it will recover in a few days.
Mm-hmm.
It's not like in Q4 2018 or in March last year. You just continue to have this selling pressure, right, for a long time, for extended period of time, every day, day in, day out. For this right now, the dynamic we have is bank will have this temporary dislocation. JP Morgan is getting pretty close to their SLR limit, but they're also a very big prime broker in the market.
Do a quick definition of the SLR. I know in your article, which I'm going to put in chat, and this is also an interview, so it's podcast, they can't see the article, but
right.
My point is go to fed.tips. This is your website, right?
That's right. Thank you for the yeah.
And there's a great article on this SICO market, and specifically your definitions. So but real quick, go through that. So.
And there will be a couple of articles coming out today as well. I've been editing a lot of articles on this. There's lots of the details.
All right, so overview of SLR, please.
Okay, SLR is a very simple concept. Basically, banks have a certain amount of capital, right? They're basically their market cap. There's the value of their stocks, and then some cash they hold. The total balance sheet can only be 20x that, 20 times their capital. That's the allowed balance sheet size for a bank. And you're asking, why do they have a huge balance sheet? Because they have deposit from their clients, they have loans, they underwrote, and they have treasuries they've been holding. There are lots of they're having a little bit of capital. They have a much larger book. because they manage money for their clients. They issue loans, right? So this ratio was put into place as a legal binding requirement by the Federal Reserve back in 2018. That's part of the Basel III Accord. And it was not supposed to be like this. So this is right now we're in an unintended consequence of the regulation because of the massive QE and MMT we're doing right now, which probably is necessary for the economy right now, but this is a completely unintended consequence of stretching the regulation. So this 20x limit was supposed to be very lax, and we're not supposed to breach it easily, but now we're breaching it because Fed is doing QE, converting UST into bank reserves. Treasury is issuing a lot of new Treasury bonds, Treasury notes, right? We're running about $3 trillion of budget deficit right now. So that's 3 trillion of new Treasury bond adding into the market. And banks are, taking a lot of those, not 100%, maybe just, 20, 30%, but still that's a lot. And that increases their balance sheet size. You also have these TRS, the total return swaps, where hedge funds are using, and that's also part of bank's balance sheet. The rule right now is the notional value of a TRS, and you multiply that by 5 to 6%, depending on who's doing that, and depending on what kind of security, what kind of equity, what kind of index, what kind of is it a commodity? Is it it is based on credit, corporate bonds, or is it based on rates? What kind of TRS you're doing? There's a slightly different percentage. All of these cost banks balance sheet space. For example, JP Morgan, I think in their 10K from last quarter, from Q4 2020, you can see they actually have $600 billion exposure, $600 billion of worth of derivative that they need to carry on their balance sheet. The capital they have is around 227 billion dollars, but the derivative exposure is around 650 or 680 billion dollars. So there's a lot of balance sheet space required for banks to operate as a broker dealer to allow the hedge fund to lever up.
Okay,
and
so basically, just to kind of make sure I'm on the right track here, the balance sheet cannot exceed 20 times their tier 1 capital, right?
That's right.
So define a little bit what goes into tier 1.
Tier 1 capital, that's a little bit to the detail. Tier 1 capital is the basically the common shares of the banks, the cash they hold, like the retained profits of the banks, and other sort of the equity part of their book. That's their tier 1 capital.
So this is for many banks globally, right? Because I mean, obviously it's a U.S. protocol, but at the same time, global QE has been going on for years now. So this has got to be a recurring.
Yeah, this is a global requirement. But to your point, every country has a slightly different rule for the SLR.
Okay.
For example, banks from UK, like HSBC or Barclays, they do not have to count bank reserve into their balance sheet.
Oh, convenient. Okay.
And European banks, like let's say BNP or Deutsche Bank, their SLR calculation only has to be done near the end of the quarter. That's why they do their window dressing near the end of the quarter.
Okay.
For US, it's pretty strict. It's a daily averaging of your balance sheet.
Okay, so this was something that was basically a requirement that was removed back during the COVID panic, and then it basically, this March 31st was put back on?
This is only put back on the US banks. So it mostly affected 8 biggest US banks here.
Did you expect it, or were you surprised by the announcement?
I was conflicted about this. This is a issue that I think Federal Reserve need to solve. Probably take the Bank of England approach to waive reserve fund requirement, but keep everything else, like putting the Treasury Treasury bonds as part of the balance sheet requirement, total exposure. But I'm not surprised that they did this because of political pressure and as well as the overall risk to the banking system.
But also, isn't it supposed to be in place to kind of limit speculation? And we've had a lot
Yes,
of it, right? I mean,
yes,
we're looking at a lot of, equity inflation, commodity inflation, housing bubble, globally. It's not just relegated to Vancouver, or parts
right,
of Florida. It's everybody where.
right.
So,
So actually, when Bank of England waived their reserve from the total requirements, they increased the SLR for British banks to 6.5% from 5%. So they were giving some relief, but they're taking it back by increasing the ratio. So their balance sheet has to be smaller. It's like only 16x of the capital.
okay, so required capital, or they have to have the required capital or reduce loans, right?
Right, right. And the other thing right now that is important is because of this zero rate environment we're in, banks are not motivated to raise capital, right? Just imagine this. The current IOER is only 10 BPS, 0.1%, right? And according to SLR, you can leverage by 20x. So for every dollar you raise for capital, you can take on $20 from your customer as deposit. But that $20 only generates like 2% of return annually on your capital. And the bank is looking at like 10% return every year, something higher than 2%. So they're not motivated to raise capital right now just to accommodate more bank reserve. If they are more motivated to use their balance sheet for TRS, which has a much higher margin, right? You can charge your hedge fund clients a lot more.
When you say TRS, define that as well.
TRS is a total return swap. It's one of the derivatives that banks use to give their family office clients or hedge fund clients large leverage. It's somewhat similar to CFD, contract for difference, or
And,
it's like,
they make good fees from that.
yes, they make very good fees from that. And it's very efficient for their balance sheet because you only need to count like 5% of that as your balance sheet cost.
Okay, so are they going to curtail or limit that activity? So it reduces fees that they charge to hedge funds and family offices, but it also, begs the question, are they going to do some more buybacks come June? Because they were allowed to begin again, but will they want to?
They probably want to, and they've been on this buyback suspension for almost a year now, right? 15 months. So they probably want to do that. So this is not raising capital. This is actually trimming your capital even more. Okay, what happens when you breach your SLR limit?
Yep.
You cannot pay bonuses. Some discretionary bonuses is not allowed to pay it out, and there are quite a few things you cannot do for bank executives. It really hurts them. Actually, if you look at the 10K, most of European banks already have breached the SLR limit. For example, UBS has breached their SLR limit Q4 last year. So it's at 4.7 right now.
Okay.
That means they don't have balance sheet capacity to accommodate US QE. And then, ECB is doing QE as well. Everybody's doing QE. Banks don't have a lot of balance sheet space for that. They already used up the balance sheet space. And they're not motivated to raise their capital. And this is a zero-sum game. If some more money, more bank reserves is coming into the system, then something else has to give.
So this sounds more, akin to tightening than loosening.
Yeah, it's a crowding out. It's a tightening because of it's a tightening for the highly levered derivative market, and
Okay.
that's
Tightening for the highly levered derivative market. That's okay. That's the good way. I get that.
right. Right. Yeah, it crowded out the commercial loan just a little bit. It hasn't happened a lot yet because the commercial loans are not like the accounting on the the bank's balance sheet for SR purposes is different from the derivatives, and also their margin is different. That sort of sit in the middle. What's being clouded out first was the low margin business, which is banks are not motivated to hold U.S. Treasury anymore. So that was the immediate consequence of the crowding out, and you saw that in February.
I think they were front running that actually into February. It didn't just happen in February. I mean, bonds had already dropped 20% from their August high, and then they just picked up speed this year. And in February, they just picked up speed, but it had already begun.
Right. Yeah, there's a lot of reasons for Treasury to go down, and this is just one more. Right, this is just one more reason for it to go down this track. We're on a temporary reprieve from that because the Japanese banks are coming back from their end of the fiscal year, sort of a blackout period. They can now buy stuff, so you see some buyers coming back to the market.
I just saw this morning actually. Japan beats out China for holding of our treasuries.
Yeah,
foreign holders of our treasuries. Excuse me.
There's still a lot of foreign buyers there, like insurance companies, for example, for Japanese and for German insurance companies. It is pretty good deal to hold the U.S. Treasuries for them than holding their own sovereignty bond, right?
Okay.
It's just the banks are not
They're not going out of style. I hear you. You have a position though on bonds? I know we're bouncing about all over, but this is very, this is how I work. So, do you have a position on bonds?
I don't right now. I don't, because I'm doing very short term, 7 to 14 day trades, and it's
really? Okay.
Yeah, it's very. There are too many conflicting factors that's at play right now, so it's not very clear. I think that we're going to rebound a little, and then once the end of the Q2 is coming, once the banks are freaking out about the balance sheet again, you're going to see selling pressure.
I said the same thing. I said, I think in June we see it again. Yeah, that's my call. I think we have more to drop, but 20% is a good place to have a nice solid bounce. Okay, so let's go back now to, because we talked about SLR, and I know I'm going all over the place, but that's how I work. That's how I think. It's scary, I know. But TGA, the Treasury General Account, how is this all, because we got to get back to the Fed liquidity and how this is impacting the flows.
Right.
Talk about that, because you just talked about how banks are now, bumping up against their SLR requirements on top of the fact that we have, Yellen with a whole bunch of money that she's got to find a home for.
Right. So TGA went up from and sort of a more typical 200 to 400 billion dollar level to 1.6 trillion dollar.
Huge.
Last year, because I think, well, the official reason is Mnuchin was expecting a new stimulus bill. I think the other reason is he wanted Fed to do more QE, because if you ramp up TGA, that kind of forced the Fed's hands to do a little bit more QE than necessary.
Okay, all right, but
the election happened and we have a new administration, and TGA has to go down because of that ceiling coming up in August, right? So TGA basically is the same kind of account that Fannie and Freddie have in Federal Reserve. So it's basically it's a big pie, which is called the Fed balance sheet, right? Part of it was the bank reserve, part of it was TGA, and part of it was the Freddie and the Fannie's account, and part of it is the cash. The cash part is the circulating US dollar bills, which is very, it's a relatively fixed amount. It's like slowly growing fixed amount. It doesn't fluctuate by $100 billion overnight. Like nobody's printing $100 billion or taking back $100 billion bills overnight. Freddie and Fannie does that. They do that once a month. And then we have this Treasury Department that does that quite often as well. The last time they did it was on March 17th when they sent out the stimulus, the last round of stimulus check. The total amount was $271 billion being pushed out. in one morning before market open
Interesting.
on a Wednesday.
And did you anticipate that? Did you see?
I anticipated that. I didn't expect it. I was anticipating 240, but it ended up being 271.
Okay. And right then the market did pull back for a solid week.
It happens the day after. I think banks anticipated that too. And there was some preparation for that. But then the day after, money gets shuffled around, and some banks are like, we cannot handle this anymore. We have to cut back on some other things for a few days until we figure out how to put this money. Then the market crashed big time. Yeah.
So is it causing kind of a shrinkage of the money supply? Is this, I mean, your thesis for why market would pull back obviously was right. How, and I know how you played it. Obviously, I'm assuming puts
Right.
on the major indices, and you're obviously you are tracking the timing of this stuff, but functionally, what's happening? Like, how is this?
It's the same as Freddie and Fannie's cash flow. It's the crowding out. It's a very acute, large number of dollar coming from just suddenly appeared, being helicopter dropped into some big bank's account,
So
and
it isn't okay. Continue. Sorry.
and they have to manage their balance sheet in for the next couple of days, and then they
Okay.
not giving out more TRS, the total return swaps. They're not giving out the buying powers of a hedge fund are being tied up.
So it's the same thing. It's tightening of the highly levered derivatives market.
Right. Exactly.
Okay. All right. So it is more like QT than QE for that short period of time.
Right. For a couple of days, it felt like a QT in a very weird way because we're in a zero-sum game on the balance sheet, bank's balance sheet.
So now, how does this change with the political regime? Obviously, trying to get or saying they're trying to get money now into the economy, into the hands of consumers. Banks, still their choice to loan or not to loan. But in regards to actually getting it into the hands of consumers to spend, now what? I would think this is, your complicated reason for why you are only short duration trading.
Right. Yeah.
You don't trust something.
So this puzzle has so many moving pieces, and it's kind of there are many competing factors here, right? So number one is there are money going into the real economy or going to the sort of consumer market, especially through mortgage-backed securities, through refinance of loans, right? Refinance activity is now 70% of the new MBS origination. 70. It was 30% in 2020, early 2020. Now it's 70%.
Say it again. What's 70%?
For all the new loans originated, mortgage loans originated, 70% of that is refinanced.
Okay, thank you.
And we are getting the latest data I have, which is, I think January this year, we're getting out about 50 to $60 billion through cash out refinance right now.
Whoa.
Every month.
Whoa.
Yeah.
Whoa.
So that's cash out, and also there's a lot of new buyers. Millennium generation are buying houses, right?
Totally. The demographics are gorgeous. I had Logan, a fabulous real estate data analyst, on, who said we've got the perfect storm of low interest rates, historically still low.
Yes.
We've got the millennials, that have a burning desire for the next few years, numbers, if you will, has a solid tailwind. And then, of course, low supply of housing. There are more real estate agents than there are houses available on the market. So it's the perfect storm for a housing bubble. And now you're also saying they're cashing out on top of that.
There are lots of money being printed here, about 120 billion every month.
Okay.
So Fed is buying 40 billion of that every month through QE.
Okay.
Regional banks are buying another $40 billion of that every month. And then foreigners are buying $40 billion of that every month. So that's adds up to about 120 billion.
That's going back. That's okay.
That's going to the real economy, I
Yep,
think,
real economy.
a lot of it.
Yep.
It's not going through the commercial and industrial loans. It's not going through the PPP loans have contributed a little bit to the money printing. So the money printing, like the real money that circulates in the real economy, well, let's just say part of it. Part of this $120 billion go to the real economy. Part of it is still just speculation for the houses, right? That's like housing market boom. That part of asset bubble. Then you have the deficit spending, the $3 trillion deficit. That is real money printing. That's exactly the same as commercial loans, the credit creation through banks writing loans.
It's only 3 trillion. I thought it was 5.
About 3 trillion right now. We're losing track of these big numbers, right?
I know it, and more to come, right? If they get this reconciliation passed over filibuster, it looks like a few more years and a few more trillion.
Yeah. But other than that, I don't see a lot of money printing beyond this. So if you say like Fed doubled its balance sheet in the past 12 months, that is true. But the Fed did not or wasn't able to double the M2 by a factor of 2. And this is completely limited by the bank's balance sheets. So only the things that the banks cannot control, like deficit spending, that is increasing the money supply to the real economy.
Okay, so and Yellen has a lot of money to spend, also to satisfy, you said, the debt ceiling requirements coming due in August. So what does that mean? April through August. What market impact? What does that mean?
That would mean that we right now have at about $950 billion at TGA balance. It will probably drop to 200. So we're going to have to add $750 billion to the bank reserve. And banks have to raise capital or suspend their buyback or trim something.
So how are they going to raise that capital?
I don't know. It's a very tricky issue, right? And they also want to pay their bonuses. So somebody's gonna get squeezed. Somebody's gonna get squeezed.
And it could very well be that very highly leveraged derivatives market.
Could be, yeah. There is one way for them to funnel this money to temporarily to something else, right? There's this reverse repo,
which happened in September
no, September 2019. That was a repo blow up. This is a reverse repo. This is the inverse of that.
Okay.
A reverse repo can soak up maybe $500 billion via money market fund. So the money market fund will hold some of these cash or hold these part of the UST or whatever security balance on their book as opposed to bank's book. But that would
as long as it's not negative, that would be a disincentive.
Right. But it costs a lot of work for them. They're not a charity. They're not like just doing this for free. They do want some payback, and it's not a very easy solution for them. And the other thing would be for foreign banks to take this on. But right now, the foreign banks that have the capacity to take on more US dollar reserve would be Japanese banks and British banks. European banks, they're already breaching their SLR, and they probably want to go back to 5.0 if they want to pay their bonuses, right? So HSBC, Barclays, Royal Bank of Scotland, those banks could potentially come in and absorb some of the reserve. But why are they doing that? Like, what's the point for them doing that? I don't see a lot of incentive for them to get involved in soaking up these bank reserve, given the low rate environment we have.
So does that translate to tighter lending conditions and tightening of the derivatives, leverage market? I mean, both kind of in the real economy as well as in our monopoly one that we trade in.
Yeah. And it's probably going to be okay for the first months of the quarter, for the next couple of months. So April probably will be fine, and July probably will be fine, and October will be fine because at the beginning of the quarter, because this SLR is calculated average over the entire quarter. So in the beginning of the quarter, you can try to increase your activity in the high margin space, like lending money to hedge fund, right? But in the second half of the quarter, the banks will look at their balance sheet and then decide what to squeeze. So in second half of May and in June, again in August, second half of August, September, we can see quite a bit of tightness in the market involving high leverage, involving in the derivatives, I think.
All right. So you said basically July.
July will be risk on, yeah.
Yes, risk on. So we have that same thing like June. It's
Right.
start again with the bond thing. All right. So July, and then of course October. Oh, fun.
So right now we're in the risk on environment right now, right? So April, July, and October, and in the past few days, everything's been rallying. Nobody is concerned about balance sheet at all because they can average it out later.
Okay. All right. So a few questions while you've been talking to hear if you see any long-term implications of this bank lending contraction.
I think something's gonna break, probably again spectacularly. Probably either the best time for something to break would be maybe August or September, because Fed said something about the SLR at the end of March. Basically, they want to do a 6 months trial period right now to go back to the old SLR rules. If something breaks within the 6 months, if there's comments coming in, they may consider a change. For example, by waiving bank reserve as part of the balance sheet calculation. But after that, they probably will be sort of in transit, sort of kind of slow or being unwilling to do anything about SR for a little while. So if something breaks before end of September, we could probably expect a very quick change from the Fed, just waiving the bank reserve as part of the SR calculation at all. And if they do that, I would expect a huge risk on rally once that happens, because basically that would free up about
If they extend, you mean?
Well, we already ended the extension. There's no waiver anymore. If they go back to a waiver, even just a partial waiver, only waiving the bank reserve from the calculation, that would give like $3 trillion of balance sheet space to the banks. That's like
Yes.
$60 trillion of TRS to be written to the hedge fund if they want, right? So that's a huge amount of leverage they can immediately add on. So I would expect
whisper of that as well. If they run that up the flagpole, for example, let's say we have a little downdraft, right? And then they just whisper that they're considering it. That's going to be the automatic Fed put,
whispering doesn't help. I think like JP Morgan is going to fall below 5% already at the end of this year. It's so close that JP Morgan is going to freak out because they still want to pay out their bonuses.
Yeah.
$1
million ones. All right. So this is
so
if
if
it has nothing to do with the debt limit. You're not worried about debt limit getting extended. You're talking about the reserve requirement getting extended. That would be most market bullish.
Debt limit is a given. It's already built in, and I would expect that would squeeze the market, the equity market, anything that involves leverage to have this rally would be probably squeezed during that time.
Can you see any reason why they wouldn't? I mean, like, let's talk rates. Let's talk, some type of political backdrop. What are the event risks to that scenario?
To the debt ceiling, to TGA?
Yeah, but this extension, I have to, unless you have a better word for it, I'm coming
It's
up.
going, destiny will be extended for
Mhm.
sure. I don't think Democrats never fight for create any noise on destiny, so it will be extended, probably for 2 years. So, but Treasury will not ramp up PGA back up to 1.6 trillion. There's no reason to do that. It will probably just stay somewhere between 200 and 400 billion dollars. Like literally, there's no reason for Treasury to keep 1.6 trillion dollars of cash at Federal Reserve for no reason, right? And they're paying interest for that. So,
Okay.
uh, so the bank reserve will balloon by 900 by well 700 billion dollars by August. That's a given as well. They might be able to the banks might be able to alleviate that pressure a little bit by using the reverse repo program,
Mm-hmm.
probably for 400 billion dollars, but still that's 400 billion dollars they need to digest. And then we still have about 100 to 200 billion dollars in new U.S. Treasury bonds and notes being issued every month. So that's a lot of things added to their balance sheet. And somebody need to buy ES and NQ. That's all a lot of
Yeah.
balance sheet space required on there. So it's going to be a pretty bad squeeze. I foresee in the second.
Really? Okay, so
Yeah.
you see this as kind of a spike higher, but until then, we could have some turbulence and tightening conditions. Sorry, my cat always comes to say hello around the dinner hour.
She's cute.
I have to like remind her it's not 5 yet. All right, so Thomas is asking, wouldn't Fed bank audit, or you can read it, in Q2 and bonus buyback permissions?
Yeah, the banks will have to. The banks submit they call it Pillar 3 report to the Federal Reserve every quarter, along with their 10Ks, and they have to satisfy the SLR requirement before they can issue bonuses. Otherwise, they can still issue bonuses, but then if they breach that limit, they have to claw it back. So
Okay. This is totally fascinating. Because obviously it's granular in regards to the size of the supply and how it impacts the derivatives, like I had to write this down to get it, the tightening of the highly levered derivatives market because this is the crowding out and the reserve decisions politically, what will happen. You still see some potential cracks or breaks, but if they do come through in this, post debt ceiling August timeframe, and basically relieve the banks of this concern and this limitation in reserves, then there'll be a hyper mode risk on rally, is what you can foresee.
right, or if they don't, if the Fed decide not to do anything and just sit on their hands, then we're gonna see this more and more pronounced second half of quarter squeeze, and especially at the end of month, or like near 25th, you're gonna see all these squeeze more and more pronounced every month because QE is not stopping. Deficit spending is not stopping, right? So every time these money comes out, the banks have to deal with it. They can anticipate some of these inflow. They sometimes sort of squeeze it ahead of time, 1 or 2 days ahead of time, but sometimes they don't. Like you can anticipate this, and then you just have a really large market move, 4%.
All right, this is fascinating, Barton. I'm still like I'm all the numbers are swirling around, and how you time it with market direction. Ultimately, there's just so much money and liquidity that the market just goes up and up and up until something breaks. And when you talk
Yeah,
about the margin loans, and it's got that shadow banking side, we're not quite sure, and we definitely have this reflexivity that's going on in the options market. We can see it, the size, if you will, and such, and the minuscule reversions, and that's why you're on such a tight time frame. I get it. Any parting words on what would be your risk as it relates to, you'll know it when you see it, something just doesn't sit right in regards to the Fed liquidity and the mechanism, if you will, breaks down.
Yeah, I would use like a pretty good rule of thumb that we can use is usually you watch how the market moves between the 15th and 20th. And if during that time, the market has already been driven hard by the bank reserve numbers, then you know that from the 20th to the end of the month, it's going to be pretty bad.
Okay,
Things will,
so the drawdown, it'll be brief, but it'll be more severe. It'll be faster.
yeah, the oscillation, the magnitude will be a lot larger, right? Just remember back in 2019, that repo crisis in September, it was triggered by something like $90 billion, right? $90 billion at the time was triggering that. That's the last nail on the coffin that caused the whole blowout of the rates, 10%. And these days we're dealing with like 200 billion, plus 200 billion, minus 200 billion every other day.
Yeah.
On last Wednesday on March 31st, right? So the Treasury took back 126 billion just on that day. And then they spit it out back on the April 1st and April 2nd. So it's just very bipolar, their cash flow.
So how does this affect currency? And currencies, I mean, are so dependent also on these swaps. Is there any part of that I got to ask?
It does.
I'm looking at the bonds that fell very precipitously from January till March. At the same time, the dollar yen carry trade was up and away, like
right.
Exactly.
Right.
Like,
right.
Exactly.
Right. Yes. It's and actually back in 2018, the dollar and euro correlation with the Fed the liquidity flow is even better and longer. Like throughout the summer of 2018, that USD EOR tracks with the liquidity flow consistently, even though the equity was not tracking that because of the option flow. So this is a big factor, but ECB does QE too, and they also have liquidity operations. So sometimes that's canceled out. It's not just on the Fed side. And ECB is not as transparent as Fed in like publicizing or publishing everything.
Mm-hmm.
Fed is really transparent in this regard. Bank of Japan as well. They don't publish like their QE by day, like 2 weeks ahead of time.
They're not like ARC posting their daily trades.
Right. That's right.
Yeah, I want the margin loan information when you find it. Okay, so I know it's after 5, but I'm just fascinated by this. I want to know what you think about this chart. I just tweeted this, and wait on. Can you see this, by the way?
Yeah, I can.
Okay, just put things into perspective. It has to do with this topic, so I have to ask. The S&P may have hit a new all-time high, but if you put the index in relation to the Fed's balance sheet, we're talking ratio, it is trading at the same level as in 2008. So equities have traded sideways. This kills me. Just because, of course, bulls are using this as an argument for why equities will go higher. But at the same time, this also means Fed balance sheet has to keep going higher. Interpret this chart based on.
This chart you can probably say, hey, this is how the overall leverage is getting less and less over time.
Oh, you mean diminishing returns?
Yes.
Okay.
And the base money has not flowed even into asset prices as efficient as they can, because there are other pieces of the puzzle like SLR is limiting how banks can issue leverage, which I think is a good thing.
Yep.
Yes, and then I think one of the audience asked about Wells Fargo having their asset freeze being lifted will be lifted in July. Yes, that would help a lot in alleviating the pressure, but it takes time for JP Morgan to move money to Wells Fargo, and Wells Fargo may not like to do a lot of, well, Wells Fargo can grow, but not necessarily soaking up all the liquidity, all the need for the liquidity, all the liquidity injection very quickly. So I think that would still impact the market. Like right now, Goldman, Morgan Stanley, they haven't breached the SR limit. They're just getting more and more careful in the second half of the quarter and in the second half of the month. So yeah, Wells Fargo will help, but not solving this problem.
And more treasuries can also get sold in the second
Exactly.
second half of the second quarter.
Yeah, yeah.
Okay. I want to share your website. This is fabulous talk. So many layers of this onion. Fed.tips is your blog site and your subscription newsletter. You have a very detailed approach to tracking this flow of Fed liquidity and the plumbing and funding markets and how it impacts everything, especially in derivative markets, which we both spend a lot of time studying. And I just really appreciate your time and your insights. And I want to just remind everyone that I'm going to post this on my website, on my YouTube channel. Barton, thank you so much. I appreciate it.
Thank you for having me on, and hope to chat again when maybe at the when some of the liquidity squeeze was happening will be happening.
Trust me, I will be keeping these dates in mind. It's already on the calendar. Yes, you got a few thank yous. Thank you again. Have a great night, everyone, and see you Tuesday with Jonathan Gibbons when we dig into all kinds of disruptive stocks. We're going to go a little bit micro next time. Complex subject, indeed, Philip, but great insight. Thank you so much, everyone.
Thank you.
All right, take care. Bye-bye.
Bye-bye.